A company listed in India just printed a 115% profit jump in a single quarter. A company with Citi, Nestle, Costco and Philips as clients, revenue of 3,300 crores growing 19% year on year, and now completely debt-free with 2,052 crore cash in the bank. I am doing a complete breakdown right now. Technical analysis, fundamentals, valuation, risks, because results like these deserve serious attention, and I want you to have the full picture before you make any decision. Let's get started. Before we talk about the company, let's set the stage. We are talking about the data analytics and AI market, the DAAI space. This market was worth $143 billion in FY 2025, and by 2030, it's projected to double, reaching $310 billion. That's a compounding growth rate of 16.7% every single year. Now, the market is growing at 16.7%. This company is growing at 18% CAGR, faster than the market it operates in. When a company consistently outgrows its own market, it's taking share from competitors. The best analogy I can give you, imagine investing in the internet infrastructure in 1999, but with an actually profitable business underneath it. The TAM is massive, the growth is real, and this company is right at the center of it. So what does this company actually do? Let's break it down clearly. The business runs on two distinct engines. The first and primary engine is their core AI segment. This is the revenue machine. They build AI products and services for the world's largest corporations, Fortune 500 companies, helping them make smarter, faster, data-driven decisions. They have a proprietary agentic AI platform, conversational business intelligence tools, full-stack Gen AI solutions. This segment is profitable, scaling fast, and generates the bulk of revenue. The second engine is what I personally find most exciting for the long term, their Alpha Incubator. This is where they've built and spun off completely independent AI companies. Asper.ai for revenue optimization, Analytics Vidya, one of the world's largest data science learning communities, and Cure.ai, a healthcare AI company tackling tuberculosis, lung cancers, and stroke detection using AI. Now, this second segment is currently loss-making, but those losses are narrowing every single quarter. From 283 million rupees in losses in FY25 down to 170 million in FY26. And when it turns profitable, the value unlock will be significant. Citi, Costco, Nestle, Mars, Philips, Mondelez, Franklin Templeton, nationwide. These are some of the most recognizable, most valuable brands on the planet. Companies that spend hundreds of millions of dollars on technology and AI every year. But it's not just who they serve, it's how long they've been serving them. The average client relationship length is over 8 years. In the fast-moving tech world, nobody sticks around for 8 years unless they are getting real, measurable, undeniable business value. Net Promoter Score of 77. For context, the IT services industry average is somewhere between 30 and 50. A score of 77 means clients are actively recommending this company to other companies. Now, I won't ignore the concentration. Top 10 clients contribute 53.8% of revenue. That is a risk, and we'll address it in the risk section. But the flip side of concentration is depth. Having long-term relationships with the best companies in the world is a genuine competitive moat. And now the numbers. The FY 2026 results dropped this morning, and I want to look at every key metric. Look at this revenue chart. From 2,196 crore in FY 24 to 2,765 crore in FY 25 to 3,300 crore in FY 26. Consistent, compounding, uninterrupted growth. Q4 FY26 revenue 886 crore, up 17% year on year. Q4 profit after tax 118 crore, up 115%. Profit more than doubled in a single quarter. Full year PAT 287 crore, up 30% for the full year. And what stands out is cash on hand of 2,052 crore. The company is now completely, entirely 100% debt free after repaying all long-term borrowings from IPO proceeds in April. Now the net revenue retention of 117% tells you that existing clients aren't just renewing, they are expanding. For every 100 rupees this company earned from existing clients last year, they are now earning 117 rupees. That is a business with genuine pricing power and value delivery. Healthcare and life sciences up 82% in Q4. BFSI up 32% for the full year. These are transformational growth numbers. Where is this revenue coming from? Geographically, the Americas lead at 68% of total revenue, primarily the US. Europe contributes 18%, and Europe grew faster in Q4 at 24% year-on-year. India and the rest of the world make up the remaining 14%. Now, 68% US exposure is both a strength and a risk. It's a strength because the US enterprise market is the deepest, highest value technology market in the world. Companies there pay premium prices for premium AI solutions. But it's a risk because any significant US macro slowdown hits this company directly. By sector, healthcare and life sciences absolutely stole the show with 82% growth in Q4. The company was selected as a strategic execution partner by a top 5 US life sciences company for 2 flagship AI companions in pharma marketing. That is a landmark win. BFSI at 32%, CPG and retail at 18%, TMT at 15%. 4 different sectors growing simultaneously. That's impressive diversification. Now, what protects this company from competition? Moat 1, industry recognition, Forrester leader, Everest group leader. These aren't marketing awards. These are rigorous, independent analyst assessments that enterprise clients rely on when choosing vendors. Consistently being ranked at the top tier creates a self-reinforcing sales advantage. Moat 2, client stickiness. The average client has been with them for 8+ years and gives them an NPS of 77. Trust at that level takes years to build and is nearly impossible for a competitor to displace quickly. Moat 3, proprietary AI stack. This is crucial. They don't just resell other people's AI. They've built their own agentic AI platform, Cogentic, their own open source large language model, Fathom R114B, their own deep research AI tool. Moat 4, dedicated research lab producing foundational AI models, products like Vedya.ai and Kaleido.ai. Technical innovation. Moat 5, strategic partnerships with Google Cloud, OpenAI and NVIDIA. Access to frontier technology before anyone else. Now, is this stock expensive? My honest answer is yes, it is. Let's look at the numbers clearly. At approximately 117 times earnings, this stock trades at a significant premium to every IT peer in the market. TCS 17.8x, Infosys 18.3x. Even Latent View Analytics, India's best comparable pure play analytics company, trades between 31 and 52x. This company is at 117x. So why would any investor pay 117x earnings? The answer is in the growth. 19% revenue growth, 117% net revenue retention, 47% gross margins, materially higher than any traditional IT services company, a debt-free balance sheet, and a projected 20% revenue CAGR all the way to FY30, according to Goldman Sachs. Morgan Stanley initiated coverage at overweight. Their bull case is that by FY28, the PE compresses to 27x as earnings catch up to the stock price. At that point, the valuation looks entirely reasonable. At current prices, you are paying for perfection. Any earnings miss, any guidance cut, and this stock derates hard. This is a high reward, high conviction, long horizon trade. Let's go through every major risk here. Risk 1, client concentration. Top 10 clients make up 54.2% of revenue. If a single large client cuts their AI budget, you will see it in the quarterly numbers. Risk 2, US market dependence. Nearly 68% of revenue comes from the Americas. Any meaningful US economic slowdown hits this company's top line directly. Risk 3, premium valuation. At 117x PE, there is zero room for error. The stock actually debuted 5% below its IPO price on listing day before recovering. Risk 4, talent costs. Employee expenses are 72.2% of revenue. Risk 5, promoter holding at only 17%. That's low. It means limited insider alignment with minority shareholders. Risk 6, AI commoditization. As AI tools become cheaper and more widely available, enterprises may build more capability in-house, reducing reliance on external partners. Let's look at the technical picture. The 52-week low was 733.70 rupees. The IPO issue price was 900 rupees. When the stock listed in February 2026, it actually opened at around 861, 5% below issue price, making a lot of retail investors nervous. But for those who held their conviction, today, right after the FY26 results, the stock hit a brand new all-time high of 1119.6 rupees. That is a 30% plus move from the 52-week low. And in just the last 1 month alone, the stock is up 31.6%. This is a high beta stock. It moves fast in both directions. 3 analysts covering the stock, all 3 have buy or overweight ratings, 0 sell recommendations. Average 12-month price target of 991 rupees with the high target at 1110. Technical indicators from moving averages are signaling strong buy. But the stock is at an all-time high today on lock-in expiry day. Anchor investors who were previously locked in can now sell freely. That creates near-term supply and potential short-term volatility. For long-term investors, any dip from these levels should be watched carefully and patiently. Now, the company we have been analyzing this entire video is FRACTAL Analytics, NSE ticker FRAL. Market cap of approximately 18,225 crore rupees. founded in the year 2000, and now 25 years later, India's first and only listed pure play enterprise AI company. My final analysis: bull case, if you have a 3 to 5 year horizon, this is one of the most compelling structural AI investments available on Indian markets today. 20% CAGR, debt-free, 117% NRR, world-class client base. The fundamentals are outstanding. Bear case, 117x PE with a stock at an all-time high is not the place to chase. Patience is rewarded in investing. If you found this analysis valuable, please hit like, subscribe to the channel, and turn on the notifications so you never miss a deep dive like this one. Drop your view in the comments. Are you buying, holding, or waiting on Fractal Analytics? See you in the next one, and thanks for watching.